All right, we do, though, have another first in the ongoing saga of the global financial crisis. The International Monetary Fund is issuing bonds for the first time ever as it really tries to tap new sources of funds.
The securities will offer the world's largest emerging market nations a new way of making IMF contributions as they try to get more clout at the fund. John Lipsky, the IMF's first deputy director, is in our Washington newsroom. Also with us here in the studio is Bloomberg's Kathleen Hayes.
Yes.
Let me start, John, by asking you about some of the details here, because it seems our editors are a little bit concerned that we didn't get very many details. What are we thinking of as far as yield, as far as maturities, as far as, you know, the sort of boring brass tacks details that we love to know?
Well, first of all, we've been authorized by our executive board to issue an unlimited amount up to a total of $500 billion. If we're raising $500 billion total, and so we could go up to that amount, although we're likely to be quite a bit smaller than that. The issuance is in maturities 3 months, extendable to 5 years, and they pay a market rate of the so-called SDR, special drawing right rate, which is a basket of currencies, and so this is a weighted average, if you will, of market short-term interest rates that will be payable on these marketable notes. Now, these notes are issued to our own member countries and in the amounts that they would desire, and will fund the IMF support for member countries in this crisis.
John, I just want to go back to the amount. You mentioned up to $500 billion. You expect quite a bit less than that. Can you give us a little bit more clarification? Are you thinking it'll be more like half of that amount?
Well, so far, the Chinese authorities have suggested they'd be interested in investing up to $50 billion, Russian authorities $10 billion, Brazilian authorities $10 billion, and we expect other countries will follow suit, perhaps other emerging markets, but also some developed and advanced economies may find this an attractive way to participate in international support for the IMF's efforts.
Well, you know, John, you've gotten these indications from Brazil, Russia, and China that they're very interested. Can you give us names of other countries that have expressed interest? And if there is more demand, I mean, is $500 billion your absolute cap, or could you go over it?
Well, that's the amount, the target amount that we've been authorized to raise overall for additional contingency funding for the IMF's operations. So we wouldn't be seeking anything more than that at this time. And as I said, most likely that it will be quite a bit short of that, as also our members have the option of supporting us through traditional loan arrangements. But this is an innovation, I think, an interesting one, and the instruments will be marketable among the authorized holders. So our member countries can trade them. They would have liquidity in as much as that might be convenient for our members.
All right, hang on a second, John. We're going to take a quick break, then we're going to come back and talk about what the IMF plans to do with this money. More with me, Carol, Kathleen, and John Lipsky in 2 minutes. By the way, if you want, go ahead and email us any questions or comments, mtmiller@bloomberg.net or cmasser@bloomberg.net. We'll be happy to ask them to John or Kathleen or anyone here at Bloomberg. We're taking a quick break. All right, we are back with John Lipsky of the IMF and Kathleen Hayes staying with us as well, fortunately. John, let me ask you what, if you could go more in depth on what the IMF plans to do with the money that you raise.
Well, this forms part of the $500 billion in additional resources that was authorized by the London Leaders Summit earlier this year and ratified by our own broad membership. And the idea here is very straightforward. Earlier this year, it became obvious that especially emerging market countries were threatened by the double blow of a drying up of capital flows and a drying up demand for their exports. Certainly the very decisive effort of international authorities in providing resources for the IMF created confidence that has helped to bolster emerging market economies, that they would not be subject to a total lack of financial support. Now, in addition, our membership has allowed us to create new forms of asset support, contingent credit facilities, the flexible credit line. And this $500 billion forms an important amount of contingent assets that makes our ability to support our member countries in need absolutely credible. So I think this whole process has been an important part of underpinning confidence in the outlook for the global economy.
You know, John, I know officially the IMF's message and yours is that this is not a step toward creating a new reserve currency for the world. But coming so soon after officials in China have raised that question of needing another one and had even mentioned, you know, debt issued by the IMF, it's hard not to make the connection between the two. What do you tell people?
Well, first of all, Kathleen, the total amount of international reserve assets is about $7 trillion right now. So this is, in that context, not that large. Moreover, it's clear that the dollar is and will, in the near future, in the foreseeable future, be the dominant international reserve currency. Today, about 60 to 70% of all international reserves held in the dollar form. But this is, of course, an interesting step. And it adds to international liquidity and adds to the richness of international markets. Although, again, let me emphasize, the marketable notes are marketable only among our official holders and among IMF members.
All right, John, we're going to leave it there. John, thank you so much for your time today. John Lipsky of the IMF.